Well, I think one of the first things to say is that the logistics market at the moment is showing remarkably strong growth. And certainly we've just had the best first half year we've had for ages, with a 70% increase on this time last year. And we see it's like at macro level you have all the problems of government and the problems that you read in the papers every day. But actually our parks are pretty much full up. We're running at very high occupancy rates. In Germany, over 99% in our portfolio. And we're seeing that if you've got the right product in the right place, there's a good demand for it. I mean, thankfully, the oversupply that was experienced from going back pre-2007, 2008 has very much been taken up. And in certain countries, for instance, such as Slovakia, you're seeing about 4% vacancy, which is the equivalent of 3 to 4 months. So I think that for us, the growth is there from the occupiers. And as Philip said a bit earlier, that more and more of the large occupiers want to be able to work right across Europe with one asset manager developer as they go forward. And that's again increasing. We're seeing more and more they want to work with people they know.
I'm very happy to see the result of the study conducted by CBRE and Mercer. And it's clear that what I can hope is that one day logistics investment is an asset, is a mature asset for investor. I think we are not in the situation of the US market where logistics is clearly a mature asset, but I hope it will come in Europe, and the study of CBRE is a good help for that. It's first point. The second point I would mention is that Europe is not in a very good economic trends, and clearly we are used to say that to have a development of the market, you need an increase of in the GDP. Probably it will not come in Europe before some years. But I think there is something very important, and especially in Germany, it's the reconfiguration of the supply chain. And we have not only e-commerce as a driver for logistics. I think the other driver is the reconfiguration of the logistics chain. And it means that the needs of Class A, what we call Class A building in good location and with very good specific technical characteristic will continue and probably will increase, even if we have a very low growth in the economy.
Philip, are you seeing similar things across your portfolio, or are there hotspots in different areas? Or
certainly, very similar things. Maybe just to expand on the reconfiguration story, the reality is pre-crisis average GDP growth in Europe, I think, has been somewhere between 1.3 and 1.5%. So GDP growth in of itself has not been a large-scale driver of growth in the sector. During that same period of time, we effectively developed most of what we today own and manage, being the 13 million square meters that I referred to earlier. And so the reality is the sector is very, very young, and you have massive reconfiguration occurring, largely as a result of the European Union. So supply chains are being rebuilt, and in Central and Eastern Europe, they're being built for the first time. And that trend is going to continue. Modern Class A logistics facilities in Europe versus the US. The US has more than 4 times what we have for an economy that is smaller and for a population that is smaller than the one I talk about when you talk about Europe and the UK. So, there are some fundamental things that will continue to drive demand for modern space. It's both more efficient, it's more cost effective, and increasingly also e-commerce a part of it. All of our customers need to get their goods to consumer faster. And it's not next day delivery, it's same day delivery and maybe morning delivery. And the e-commerce sector is starting to drive some of those traits. So I believe that those demand drivers are going to continue, and it's those demand drivers that have effectively absorbed almost in its entirety modern buildings of 300,000 square foot or 30,000 square meters and more. So supply is getting tighter and tighter and tighter. Why is that important? Because I think we're at or past the inflection point of rental growth. And the market for supply is going to continue to remain relatively tight. There are very few people out there that are well enough capitalized to be able to bring through speculative development, which is the real measure ultimately of the health of the market. So we've got rising rents, tight supply, which is going to really, really drive those income returns. So I think that's a really important sort of investment thesis, if you like. Just take back to the take-up piece. In 2009, first half of 2009, I don't think any of us leased a whole lot of space. The second half of 2009, out of our 13 million square meters, we did 2.5 million square meters of leasing. The point of that, and since then, and on average per annum, 3 million square meters of leasing. And so there's been nothing wrong with the key demand and take-up that's been in the market. We had 6 months where customers stood back and had to, take stock of where they're at. So the fundamental demand drivers continue. Customers are continuing to move from old to new space, consolidating from multiple older spaces into larger single spaces, as well as many of the 3PLs creating what they call campus models, which creates a much more robust investment opportunity for us because we will be less locked into short-term leases. They can operate on longer-term leases in a campus and move customers in and out. So we're hugely optimistic, and I'm going to put a number to it. We reckon that rents are going to grow by as much as 20% over the next 4 years. And that may sound very aggressive. We don't think it is. Effectively, that will still be 35% in real terms lower than the prior peak of 2001. So we're really only at the beginning. We're confident of it, and we absolutely believe that now is probably the best time in this generation to invest in logistics because we're only at the beginning.